welcome to Sectors Up Close. I'm Elena Casas. Our focus today is on how the Ukraine crisis is impacting the outlook for clean energy stocks. And my guest is Coons, portfolio manager at Winthrop Capital Management. Well, Russia's invasion of Ukraine and the surge in oil prices has sparked a sudden renewal of interest in clean energy stocks. After being in the doldrums for more than a year, these and other indices that track clean energy surged, with this index up about 12% since the invasion began last Wednesday. But this is a sector that has a history of being in and out of fashion. It surged in the run-up to the 2020 US presidential election in anticipation of a paradigm shift in global energy policy, but since then has languished, aside from a blip around last November's UN climate change conference in Glasgow. These are two of the largest ETFs that track this space. Some, like iShares Global Clean Energy ETF, include major wind turbine makers such as Vestas, solar power companies such as Enphase Energy, but also major utilities such as Consolidated Edison, while others, like the First Trust Nasdaq ETF, shun utilities in favour of electric vehicle makers such as Tesla and NIO. Well, for more on how to approach this sector, I'm now joined by Adam Coons of Winthrop Capital Management. Adam, hi! Clean energy stocks seem suddenly back in fashion this week, but is it a knee-jerk reaction to oil going over $100 a barrel, or have the fundamentals changed here?
Hi. Well, first, thanks for having me. I would say near term, yes, this is a knee-jerk reaction. Oil spiking in any type of cycle, whether it's because of an attack or not, would have an effect on alternative energy sources. It would be typical that you would see is that your input costs go up in one area, that you try to find a different way to do it, whether it's manufacturing or, in this case, oil input costs. So that is what's driving it. Valuations and overall profitability have not really changed because of this. In some ways, profitability of a lot of these alternative energy companies is actually declining because the input costs in other areas such as steel is going up at the same time, and in some cases at a higher rate than oil costs. So fundamentals have not necessarily improved here. This is more of a psychological knee-jerk reaction right now.
Outside the short-term impact of the oil price then, what is your outlook for this sector?
So to talk out of both sides of my mouth, so while the short term, a lot of the fundamentals haven't changed, long term, it's absolutely undeniable that we're going to need to move towards a more renewable energy source. And too often this turns into a political issue, but the facts remain that fossil fuels are a finite resource. So we need to try to find new ways to produce energy. So because of that, we absolutely see this as a long-term investment. In particular, we like solar the best. We think that advancements in technology, in particular advancements in battery technology, will mean a lot for this in the future, and the ability to transport energy is a little bit easier as, like I said, the battery technology improves. We do like wind, but costs there are an issue, and especially right now with steel prices so high, a little bit cost prohibitive. And so input costs are going to be the major detriment to wind. So overall, long-term secular viewpoint on alternative energy, absolutely, we're bullish on it.
Let's dig more into that input costs problem, though. How much are higher commodity prices dragging down development in this sector?
Well, if you looked at a lot of the wind turbine companies where 70% of the final input costs come from you're seeing profits drop pretty significantly, and roughly around 70% that you've seen profitability decline over the last year. So that is a major headwind. But you also have to remember that with wind, oil is a major component in running those. So with oil prices up, it does also make it harder to generate a profit and to make those make any sense. So that's the downside to wind that solar necessarily doesn't have. The issue with solar right now is the chip shortage. So we all know that there's a shortage of microchips across the globe, and so that's making it more difficult to make deliveries, finished product, and then the overall just cost of producing them is going up. So near term, that is a significant issue. The chip shortage, we believe, is not a long-term issue, that it will get resolved as you're seeing more foundries built even here in the U.S. So that's why we're kind of favoring solar over wind in this renewable energy type space.
How would you advise investors to approach this space right now then?
Cautiously, as I mentioned, because fundamentals haven't necessarily changed here, and this is more psychological. That means that the volatility around these particular ETFs you mentioned is going to be heightened. So we would say, position sizing should be smaller than your typical position right now. Do not view this as your, old utility stocks that paid a dividend and barely moved. These do move quite a bit. So smaller position sizing, start slow, and kind of build the position over time. I think that's the more prudent way to do this right now.
Thanks so much for that insight. Adam Coons, Portfolio Manager at Winthrop Capital Management. Well, before I go, here are some of the top stories in this space. Europe's largest economy, Germany, has taken more steps to diversify its energy supplies in a bid to cut dependence on Russian gas. The government announced it will buy $1.7 billion in liquefied natural gas from non-Russian sources and slow its exit from coal power. Thursday's announcement is the latest sign of how the invasion may disrupt plans by Germany and other European nations to transition to carbon neutrality. Germany's largest power producer, RWE, said it was open to the idea of delaying the shutdown of Germany's coal-fired power stations or even restart ones mothballed under the country's plans to exit coal. The White House says it is open to sanctions on Russia's oil and gas flows, but said going after its exports now could help Moscow rather than hinder it. Washington has already slapped sanctions on exports of technology to Russia's refineries and on the Nord Stream 2 pipeline to Germany, which never opened. But it has stopped short of targeting oil and gas exports due to the impact that could have on energy prices. About 8% of US liquid fuel imports come from Russia. And Ford Motor has announced it will boost spending on EVs from a previously announced $30 billion to $50 billion through 2026 and run the unit separately from its legacy combustion engine business. The reorganisation by CEO Jim Farley is aimed at catching up with industry leader Tesla. Farley said Ford plans to build 2 million EVs in 2026, which would be about a third of global production. The announcement stopped short of calls by some investors to spin off the unit as a way of extracting full value from the business. And that's your roundup of the clean energy sector. I'm Elena Casas, and this is Reuters.